Did you know a ton of crypto investors lose big? Sometimes everything just because they miss one simple strategy. It's called the 70-20-10 rule, and it could be your key to avoiding catastrophic losses and making just obscene returns in crypto. We're breaking it all down. How this approach works and how you can use proven methods like staking and yield farming to keep your portfolio humming safely. Here's the deal. The crypto world can feel tricky, but this is actually pretty straightforward. The problem is too many people pile into high-risk bets like those wild meme coins or overhyped tokens and end up with serious losses. Take 2022, for example, when Terra Luna crashed. Investors who went all in lost $40 billion almost overnight. These weren't degenerate gamblers either. Terra Luna seemed like a great investment. Terra Luna grabbed attention with UST, their version of a stablecoin. Stablecoins aim to stay fixed at $1, not jump around like Bitcoin does. Luna, its teammate coin, worked to keep UST steady whenever the price wobbled a bit. Anchor, their savings app, dangled tempting 20% return on UST. That lured people in, and in 2021, Luna's value took off fast. Early investors saw huge payouts while the hype kept building. Then May 2022 rolled around and trouble hit hard. UST slipped from $1 and Luna couldn't catch it in time. What followed was the best known crypto disaster besides the FTX fraud. That's the kind of chaos the 70-20-10 rule helps you avoid. It's a smart balance of safety and growth inspired by how traditional finance pros like hedge fund managers handle their portfolios, but for crypto so you can still make massive gains. First, you want to protect your money. You're going to put 70% of your crypto cash into reliable blue chip coins like Bitcoin and Ethereum. Also, if you trust the US government, or at least its wallet, coins like Cardano, XRP, and Solana are probably a good bet. In stocks, people trust the S&P 500 for its solid companies. Bitcoin and Ethereum do that for crypto. There's basically no chance of them vanishing overnight. Bitcoin's been running since 2009, and Ethereum powers tons of projects and is considered the clear number 2 in this space. Here's where this strategy gets interesting. Remember, no one who bought Bitcoin and held it for a 4-year period has lost any money. It's wild, but true. If you think long-term Bitcoin is as guaranteed investment as you can get, still, this is crypto we're talking about. The price will fluctuate in dollar terms, sometimes by a lot. Instead of just holding and waiting for the price to go up, start making this 70% work for you. Staking means locking coins to support a network for rewards. Ethereum works for this since its 2022 proof of stake switch. Most big trading platforms offer 4% to 6% yearly on Ethereum if you lock it up. Bitcoin's different. It uses proof of work, so no staking there. But many trading platforms, including Binance, Crypto.com, Nexo, all offer a version of this. Risk varies depending on the platform, as does the yield from 1% to 7% yearly returns. This is your safe bet. Think of the 70% chunk as the foundation of your portfolio. Keep it in a set and forget mode. Farm yield, but don't touch it and don't think about cashing out. This is the nest egg. Now comes the sexy part. You can get double, triple, or multiple X yield with a bigger risk on the 20%. This is your high growth zone. Take 20% of your crypto investment money and put it into promising altcoins. Coins like Polygon, Chainlink, Polkadot, Algorand, just to name a few of a massive selection. These aren't the big dogs. They're newer, riskier, but packed with potential. Think of them as the wild cards that could explode or flop. The most important thing, pick vetted projects that have been around for a while with a lot of liquidity. Use our checklist to vet potential coins to avoid obvious scams and rug pulls. It's about dividing your funds with purpose. The 70% in Bitcoin and Ethereum is your foundation, reliable like a savings account. The 20% is your growth play, similar to investing in a new business or stock. Why 20%? It's a calculated move. Less than that, like 10%, and even a win doesn't shift your total much. More, like 40%, and a loss hurts bad. Imagine putting most of your cash in a bank, then using 20% to buy Amazon stock in 2000. That $1,000 could have grown to $90,000 by 2020. Sure, big returns, but Amazon was far from a sure thing for a massive portion of that time. Or look at real estate. Someone might put 80% into a safe rental property and 20% into a fixer-upper. The rental pays steady, the flip could triple your money, or it could sit on the market forever. Altcoins are that flip house. Newer, unproven, but some hit big. This is all about balancing risk and reward. That's why you have to diversify. Don't just pick one altcoin. Think of it this way. If half the coins you pick slowly grind to zero and the other half blast off to the moon, you'll still be making more money than just yield farming Bitcoin. It may not get you into Lambo territory, but a couple of nice mid-sized sedans with leather seats, definitely, maybe. Besides that, this will be a bit more thrilling, fun. Backed up by your safe nest egg, you'll enjoy a bit of the excitement and actually feel engaged in the market. And if you want to experience the roller coaster ride of gambling without risking any real damage, that's what the 10% are for. Let's face it, gambling is fun, and watching some folks stack huge piles of internet cash in the space of weeks, that's fun and tempting. A lot of crypto's a casino. So instead of crawling in the slow lane, grab some exposure to real moonshots, the stuff that might flip $100 into a Lamborghini, or more likely leave you with nothing. Put 10% of your crypto cash into long shots. New tokens, NFTs, or untested DeFi projects work here. High-risk yield farming on Uniswap can pay big. Think 50% returns lending to a hot trading pool, but if it flops, your $100 vanishes fast. New chains like Kusama offer staking perks too. Lock in early, snag launch tokens. Some tripled in 2021. Take Shiba Inu. In 2021, a $200 bet ballooned to $2 million when it spiked. Or Bored Ape Yacht Club NFTs. One buyer turned $300 into $1.5 million by 2022 resale. Most don't hit like that though. Kusama stakes might net you zilch if the project dies. Keep it at 10% to limit the damage. Your 70% and 20% stay solid while you chase these. It's like tossing $5 on a slot machine. Those 10% moonshots add some excitement. You might strike it big or lose it all, but it's a small part of the plan. The whole strategy works together to make you feel safe yet engage with your investment. What's even more important is that you simplify your decision process. Instead of agonizing what to do with your money, you know where to expect losses, so weird market moves won't make you panic or exit positions that would have paid off big. Your risk is comfortably managed. Still, there's 3 more tweaks you need to make to really profit from this strategy. One is rebalancing. Every 3 months, check your allocations and shift funds based on performance. If your 20% growth segment has exploded, move some profits back into the safer 70% to lock in gains without changing your overall risk. This keeps your strategy on track without getting greedy. Another tweak is using yield aggregators like Yearn Finance. These platforms automatically move your funds between the best paying yield farms, saving you time and potentially boosting returns. It's like having a smart assistant that constantly searches for the best interest rates without you having to lift a finger. Third thing, put an exit strategy for the 10% moonshot bets. Set clear profit targets and stop losses before you even buy. For example, if a risky token jumps 100%, you could sell half to secure your gains. Or if it drops 20%, have a stop loss to get out before it crashes further. Knowing when to take profits or cut losses keeps your small bets from turning into big headaches. All of this assumes that you're doing your homework. Even with the 10% moonshots, you want to expose yourself to as much upside as possible without being stupid. Vet the project so you're not just tossing a bunch of money into a rug pull. Look for the Shiba Inu and Doge coins, not a hawk tua. We've actually made a simple, easy to follow checklist to help you avoid obvious scams and rug pulls in crypto, and it's right here. This video will give you the core knowledge you need to avoid getting scammed. So even when you're engaging in a bit of degenerate gambling, you still have a chance of making a big win instead of having your hard-earned dollars sucked out into the void. If you want to manage your money like the 1% without the stress, the guesswork, or the FOMO, hit subscribe now. We break down strategies like this every week so you can grow your wealth the smart way. Don't miss out.